we are trying to pay off the IRS now and be done. So that's not going to work. Welcome to the Retirement Cheat Code. I'm JD White, and today we're going to talk about after-tax accounts and how they function at a high level. I hope you learned something from today's video. Let's go ahead and get into it. When we talk about after-tax accounts, we have to include tax-free accounts, but the idea here is that we are paying off the principal of what we put into these accounts now versus when we put money into the pre-tax bucket, we're effectively kicking that can down the road. With these accounts, if we put $10,000 into this account today, we've paid off the IRS of that $10,000. They cannot tax that $10,000 again. So that's really important when we talk about these types of accounts. Now, the rules start kicking in when we talk about the growth of these accounts. So if we can get the money into a Roth IRA or Roth within your employer-sponsored plan, like a 401k or 403b, then as long as the withdrawal is a qualified withdrawal, that growth in that account is still tax-free. So if we put in $10,000 in a Roth and it grows to $20,000, we can pull out that $20,000 totally tax-free as long as it's qualified, which for most of us is when we reach the age of 59 and a half. There are some other ones that we'll get into in a future video. So that is the Roth piece. As far as our other accounts go, so that would be individual accounts, joint accounts, which is your checking, savings, investment accounts, and also includes things like trusts. Then the rules on that growth is a little bit different. So if we just grew the investment and we're using investments and we sell it, we're going to be looking at paying capital gains. This also includes your real estate. So if I buy a house or a stock for $100,000 today, I'm using after-tax money. The IRS has already taxed that. It's coming from my checking account. It grows to $200,000 and I sell it, then I'm going to owe some form of capital gains, whether that's long-term, longer than a year, or short-term, shorter than a year. And those have their own rates. Again, we'll get into it in a later video without getting too lost in the weeds here on taxes. There's also things like interest payments, dividend payments that we receive from these accounts as we're going. There's also things called capital gains distributions, again, a future video. But when we get dividends and interest payments, we're actually paying ordinary income on those payments. So unlike Roth, we're paying some of the income as we go, which actually increases the cost basis. So when we get down the road, we're going to owe less on the capital gains because our principal has actually grown. What we've already paid off as far as the IRS is concerned is actually growing because we're paying some of the taxes as we go. So this is quite a bit different from our pre-tax accounts. We are effectively paying off the IRS now on this money we put into these accounts. And then if we try and grow it, we're going to pay some of the taxes as we go. And then we're going to pay some of the taxes later in the form of capital gains, which is usually more favorable than our regular tax rates. So this is a totally different approach. We believe it really depends on what you're trying to accomplish as far as which accounts we're going to dump our money into. It also really depends on what tax bracket you're currently in and what tax bracket we think you're going to be in when you need this money or retire, if it's all for retirement. So that's the 30,000-foot view on after-tax accounts, which again, remember, this includes tax-free accounts and after-tax accounts because they all are in that same two different buckets, same wheelhouse. So anyway, if you enjoyed this video, I really appreciate it if you click that subscribe button. That's a great way for me to track if people are actually enjoying these. And if you like this one specifically about after-tax accounts, go ahead and click that thumbs up button for me. I really appreciate your time as always, and we'll see you on the next one.